Hello guys, our goal today is to look at the foreign exchange market and what is the foreign exchange market, how does it work, and appreciation of depreciation of currencies, even more than what we looked at yesterday when we were calculating exchange rates. So what is the foreign exchange market? Sometimes it is called the FX or the Forex market. So remember, if you see any of those terms, it means the foreign exchange. So foreign exchange or foreign exchange market. And it's all foreign currencies and all banks added up together. I know that sounds really crazy and wild, and that's because it is, okay? So we've done big economics before on a nationwide scale. Now we're just making it even bigger. So we've learned that word aggregate before. Let me make sure I'm writing. Aggregate means everything added together. We're doing that again, except we're doing it over the whole world. So this is the aggregate of all foreign currency available in all countries, in all the banks, in all the world. Whoo, buddy. Okay. So it's all the foreign currency of Japanese yen in Lexington, in Louisville, in Ohio, in New York City, in Los Angeles. It's all the Japanese yen in all the world added together. And it's not just Japanese yen, it's all the different currencies. So it's similar to the stock market in that there's not one place that this is happening. It's happening all over. All the different banks keep track of this. The supply and demand changes. It's a global market that people can exchange their money and that people can invest in. So don't think of it as like one building or one place or the government's in charge, because it's not like that at all. So who uses the foreign exchange market? Who needs this market to exist and keeps it going? Governments, businesses, and investors. So let's talk about governments first. Why would a government need foreign exchange currency? They might need to borrow money from other countries. We've talked about how the U.S. is greatly in debt to other countries. If you remember from U.S. history, sometimes the U.S. government bails other countries out or lends money out to other countries like Greece and Turkey during the Cold War. And we also give foreign aid. So like if there's a natural disaster, like there was huge tsunamis in India and Thailand about 10 years ago. When the U.S. sends foreign aid, they're not going to send it in U.S. dollars. That doesn't make sense. They send it in the Indian rupee or the currency that country needs, okay? Businesses also use the foreign exchange market to trade. So when we talk about trade and imports and exports, it's not always the government. For the most part, it's just individual businesses doing business globally. So those individual businesses need access to foreign currency in order to trade and make payments to businesses in other countries. And finally, investors. And this one's just like a side note. It's not important. You don't need to know it for the test, but investors invest in the foreign exchange market just like they invest in the stock market. So they try to make money trading currencies at different rates. So they'll buy a depreciated currency, a currency that's not worth a lot, and then try and sell it when it has appreciated in order to make money, just like the stock market. People invest in the stock market. They buy stocks when they're not worth much and hold on to them until they're worth more, and then they sell them. Same thing, except they're trading currency pairs and not stocks, which is difficult to wrap our mind around. So just a little bit about the foreign exchange market. Again, this isn't something you're going to be tested over when it comes to investing. You'll be tested over more like the graphs. But like I said, it's similar to the stock market. It's happening all over the world at all different times. They have different business hours, the foreign exchange market, but they're open around the clock because it's a global market. So it's like it's 12 o'clock here, but it's midnight in China. So they have to be open all the time. So they speculate, just like I said, they try and buy low and then sell quickly, hoping that rates will go up and they'll be able to make a small amount of cash, but they're doing it all the time, so that cash kind of adds up. So they will buy a currency pair and wait until it goes up and then sell it, just like I said. So the value of currencies, like how do I know how much a currency is worth? How do banks keep up with that? It's always changing. It's based on the current day. So how does it get that that value. The value is based on how much is available, that's supply, and how much demand there is. If people aren't buying things from that country, then the demand for that currency goes down and it's going to be less important and depreciate. If people are buying lots of things from that country, the demand for that currency goes up. And if we move that along, move the demand curve up, then prices increase. So I want you to think about it this way, though, because we're not talking about how wealthy or rich a country is. The value of their currency does not determine how wealthy a country is. It just determines how much of their currency is available and how much it is needed, how much it is demanded. Even wealthy countries can have money that is depreciated. Now, sometimes wealthy countries do have money that is worth more than other countries, but those two don't always go together. So don't think about like, oh, their currency is worth a lot, they must be rich. That's not always the case. So when we graph on the foreign exchange market, I'm going to show you an example in a second, but let me give you like a stupid little example first. So what would happen if Amazon, a company in America, okay, US, wants to buy thousands of PlayStations from Sony, who's in Japan? Japan is exporting PlayStations, PS5s, okay? America imports. They get those PS5s, okay? How does the foreign exchange currency work in this scenario? Amazon, because they're importing, needs to have yen. So Amazon in the United States must exchange its money, its dollar, for the Japanese yen. So when they are exchanging, they're giving up US dollars. So there's more US dollars available. Supply increases of US dollars. And then yen is exchanged. So Amazon puts dollars into this market, takes out yen, and gives that yen, that Japanese yen, to Sony in Japan. And then there's less yen on the foreign exchange market because it's been taken out and it's being given to a company in a different country. So let me explain this in graphing terms. Over here on the left, we've got the country of Japan. Over here on the right, we've got the country of the United States. So down here, since we're in Japan, this is the quantity of yen. Down here in the United States, this is the quantity of dollars. All right. And then these prices are currency pair prices. Over here, it's how much a dollar is worth relative to yen. And over here, it's how much a yen is worth relative to dollar. So the way I like to remember this is the country. This is how much money, their money is available. And then over here, it's going to be opposite. So it's going to start with the other country. It's hard to explain, but you can remember it that way, okay? So this is the country. This is how much money they have available, quantity of yen. And then this is the currency pair based on the other currency. So what we like to do in these, how I like to teach this in these questions is really silly, but I hope you enjoy it. I like to pretend that the foreign exchange market, which is all the money available in banks meant for foreign exchange, meant for currency exchange, in all the banks in all the world, I like to pretend that it's actually one giant bank. Now that is inaccurate economically, but it's so much easier to think it's one huge bank and every person goes to this bank and puts their money in it and then takes out money to pay another country. If you think about it like that, it's going to be easier, even though that's not true. Okay, it's not one big bank, but we're going to pretend it's the one building here. And this building is called the foreign exchange market. So in our scenario, Amazon wants to buy thousands of PlayStations from Sony in Japan. So the United States, that's Amazon, Amazon's in the United States, has to do something. They have to put their money in the foreign exchange market. They have to take dollar bills, okay, and pour those dollar bills into this bank. When they pour dollar bills into this bank, that increases the supply of dollar bills available. Okay, so supply increases of dollar bills available in the foreign exchange market. When supply increases, we find a new equilibrium and go over and down. And what has happened? Price decreases, but quantity increases. All right, so price decrease, quantity increase. All right, now when price decreases, that means it depreciates. You have depreciated the US dollar by importing something, by buying something from another country. So when they flooded this bank with US dollars, they then took out Japanese yen. So that means that yen is heading out this way. Yen is now out of the bank being poured into Japan. Sony is taking that yen to pay for the PlayStation 5s. So what happened to the supply of yen on the Japanese market? Here it was. But now there's less supply because it's in Sony's bank account now. It's not in the foreign exchange market. It was taken out. It was exchanged for dollar bills. The dollar bills are sitting here in this building. The yen is flowing out to pay Sony in Japan. So when supply decreases, that means that price goes up and quantity decreases. So the price of yen went up. It appreciated in value. All right. Now, when that happened, that meant that the quantity of yen decreased because look, the yen was going out of the bank and into the pockets of Sony. So it's no longer in this foreign exchange market. Okay. Let's do another one. Thousands of British people want to visit the U.S. We've got the USA and its quantity of money down here. Sorry about that. And the United Kingdom and its quantity of pounds right there. Okay. So thousands of British people want to come visit the U.S. That means that money is coming from the United Kingdom. They got to exchange it, and that money is going to flow into the United States. So let's go ahead and take care of that. So what's happening here? The United Kingdom is going to this foreign exchange market. It's not one place, but we're just pretending it is. They're taking that British pound, and they're sending it that way, meaning that supply of British pounds has decreased. Nope, I lied. Has increased on the foreign exchange market. Sorry. So supply has increased. Call it supply 1. Increase it. Find those new equilibriums. This is Q1. New equilibrium here. This is price 1. And what has happened? It looks like price went down, but quantity increased. So if price is going down, that means that the pound has depreciated. Okay? The British pound has become less valuable. So it's sitting here in the market, that British pound, because they wanted to come to the U.S., they have to exchange their currency. Sitting here in the market, when they exchange it, that means that now they're going to get that U.S. dollar and pay, I don't know, wherever they go when they get here. So since they've taken out U.S. dollars and they're going to use them in the USA, that decreases supply of dollars in that foreign exchange bank. So if we decrease supply, we shift it to the left. We call it supply 1. Give it an arrow. Okay. Find that new equilibrium and go down. That's our new quantity and looks like it decreased. Find that price line and go up. Label it P1. So it looks like price increased, but quantity decreased of the US dollar because there's less of that US dollar in that foreign exchange bank. So if price increases, that means it appreciated. I spelled it wrong. Appreciated. There we go. All right, let's do one more. So in this scenario, we've got Mexico and their quantity of money, the Mexican peso, and France and their quantity of money. And France is part of the European Union, so it's the euro. So what happens? French restaurants want to buy avocados from Mexico. So if French restaurants want to buy avocados from Mexico, that means France needs to come over here, exchange its money for pesos, and give those pesos to the avocado farm in Mexico. So let's go ahead and do that. So France comes over here. They give up euros. They give up euros, meaning that in this little bank, there's more euros now. Look at all these euros. Woo! So that has increased our supply of euros. So increase that supply line. Call it S1. Shift it to the right. Give me new equilibriums. Q1 and P1. Okay, so what happened? Price went down, but quantity went up. If price goes down, that means that it has depreciated. Okay, the currency has depreciated. Now, when these French restaurants exchange their money that was once in this foreign exchange market, pesos that were once in this foreign exchange market are flowing out this way. So there goes the Mexican pesos. They're no longer in this little bank. They're going out to the avocado farmers. So that decreases the supply of Mexican pesos available. Okay, so if we decrease supply, we shift it to the left. We find our new equilibriums, quantity 1, price 1, and what happened? Looks like price went up and quantity, that was great, went down. Because there's less Mexican pesos available in this foreign exchange bank. So if price went up, that means the Mexican peso appreciated in value. It got more important. So what I want you to notice here is that France was importing. And when they imported avocados from Mexico, their currency became less valuable. Okay? Mexico is exporting, right? They're taking those avocados and sending them, trading them with another country. And when they export, look what happened. Their currency appreciated. This adds into our GDP formula. Remember, C plus I plus G plus X, and X is exports minus imports. So this exports minus imports, we always say if we import, it hurts our GDP. If we export, it helps our GDP. The same is true for currency. If we import, it hurts the value of our dollar. If we export, it helps the value of our dollar. And that doesn't mean we shouldn't import anything. It just means that we should be working towards a favorable balance of trade and not always in the deficit. Okay, so you're going to hear me in class call things a strong currency, and I don't mean it has muscles and tattoos and it's really strong and intimidating. It means that it is very appreciated. So a strong currency is a currency that people want. It has appreciated. People are buying things from that country. Its worth is more, and if its worth is more, it means that they have more purchasing power. They can buy more with that currency in a different country. So a strong currency is a currency that is more appreciated. So those countries are probably exporting. Exporting causes a country's currency to grow in value, to appreciate, while importing causes a country's value to depreciate.